Learning is the key to successful investing, and who doesn't want to invest in some way?
Here at L.E.A.R.N Grow Invest, we focus on financial education, all with the aim of sharing our knowledge on personal finance, investing, and building wealth. We do this on the foundation of our faith in God.
If a more holistic approach is what you need, check out our Grow Faith-based financial coaching program.
Find out more about us at learngrowinvestclub.com
and follow us on all social media platforms at Learn, Grow, Invest.
My name is Shaniel May Brown. I'm an attorney at law at the law firm Myers, Fletcher & Gordon in Jamaica. I work in the firm's commercial department, and my practice areas include banking, corporate finance, financial service regulations, intellectual property, securities, data protection, and cybersecurity. I work on a variety of corporate and commercial transactions, including private placements, share and asset sales, mergers and acquisitions. And I also advise on tax matters, compliance, and I generally conduct extensive due diligence exercises for companies. I'm very versed in the regulatory space. I deal a lot with the Financial Services Commission, the Bank of Jamaica, and the Companies Office. And I generally do anything else that is commercial type. Today, we'll be presenting on making the list with a focus on how your company can take steps to become a listed company on the Jamaica Stock Exchange. The presentation will see us traversing the various steps which I've listed A to G. We'll first speak about engaging professional advisors, how to comply with the Companies Act, how to comply with the Securities Act, how to comply with the JSE rules, how you need to internally adjust your company's business operations, how you should develop your board dynamic, being your board of directors, and at the end, basically plan and executing the timeline to become a listed company, making the list. Before we start, there are two preliminary considerations that you should have at the forefront of your mind when you are trying to figure out if your company is ready to make the list. You need to ask yourself what type of company exists. That is, whether you have a private company or a public company. A private company, and generally most companies incorporate in Jamaica as a private company. This is where you have less than 20 shareholders and you have a restriction on the transfer of your shares, among other things. Whereas a public company, you have no restriction on the transfer of your shares, and you may have more than 20 shareholders. You can incorporate a company with less than 20 shareholders, but there's no restriction or a limitation on how many you can have. Depending on which company you are, that will affect your timeline and your steps to be taken to go to market. If you are a private company, you will have to re-register as a public company. If you're already a public company, then you're already one step ahead. The second consideration is, I know I want to go to market. Now, what security do I want to offer to the public? And I use the term security because you don't just have to go to market with ordinary shares. That's generally the practice here in Jamaica, but you can go to market with preference shares and other types of securities. Once you've identified the security that you want to offer to the public and to have it listed, then we now go right into how do you create your team, plan your work plan, and execute the plan to make the list. So engaging the professional advisors. And I started with this one because it's very important. The team you create is the team that will carry you along the path to making the list. You need to ensure on your team that you have attorneys that are able to conduct a due diligence on your company, advise the board of directors as to what needs to be done with the prospectus and the liability that arises with the prospectus, and just to deal with the regulators and handle the legal steps as you go forth in making the list. The next person on your team is a licensed securities dealer. This person or this institution will act as an arranger and broker, and is very crucial to your IPO. They will facilitate market reads and marketing the company to get investors on board. You'll also need an auditor if you don't already have an auditor. The auditor will assist with auditing your financial statements, giving consent for the use of that financial statement in your prospectus. And in some instances, the auditor will also assist with projections for the company, which may be included in the prospectus. Lastly, your team also needs to include a registrar and transfer agent. This registrar and transfer agent will be with the company for the existence while it's on the Jamaica Stock Exchange. They will basically act as I don't want to say company secretary because the company still has a company secretary, but it's similar to a company secretary offering certain services like keeping track of the shareholders while the shares are trading on the exchange floor and dealing with any transfers. Once you have identified the various members of your team and enter into different engagements, you will start having what I call work meetings to get things moved along. For the most part, these meetings will include heavily your attorneys and your licensed securities dealer. In these meetings, you're going to create a work plan or a timeline, and you're going to start focusing on the different pieces of legislation that you need to ensure that you're in compliance with before you go to market. And the first one is compliance with the Companies Act. And I start with the Companies Act because, again, the company trying to make the list was incorporated under the Companies Act. The Companies Act has specific sections and provisions which indicate how a prospectus should be drafted and the steps to be taken to have that prospectus registered. I haven't put all the sections here, but I've just put a few which are important. Section 42 of the Companies Act requires an expert's consent to be included with the prospectus. Expert here includes engineers, valuers, accountants, and any other person whose profession gives authority to a statement made by them that is included in the prospectus. In practice, you'll see a lot the expert's consent being the auditor's consent, because again, the auditor has issued a report on the financials of the company, and because it's being used in the prospectus and relied on, the auditor has to consent to that. Section 48 of the Companies Act also requires a company to state in their prospectus their minimum amount to be raised in order to have the new shares actually be issued. So you would have probably read a prospectus and seen the statement where that the company intends to raise, let us say, 500 million, but the minimum amount they need to raise is 450. That is the floor before any shares can be issued. If the company does not raise at least the 400 million being the floor, then they will have to refund the funds raised and not issue shares. However, once the minimum amount is met, the Companies Act allows the company to then issue or allot these new shares. The third schedule, which I call the most important schedule, in conjunction, of course, with the sections that deal with the liability of the prospectus, the third schedule basically gives you a framework as to what needs to be included in your prospectus. Again, the list here is not exhaustive, but it just points at a few of the ones that I think are important. It requires that the company details the ownership of the company, management, and the share capital. So this means that the company needs to set out the shareholders of the company, the directors of the company, senior executives, and the share capital structure of the company. The share capital structure is very important because it basically gives the public a snapshot of what the company looks like. If the company has more than one class of share, it needs to indicate the classes of shares and the different rights associated with those shares. If it is that the company only has one class of share, which is generally the ordinary shares, the company needs to give an background of how the share structure is set up, meaning the maximum authorized share capital of the company, if there is a maximum, and the amount of shares issued at IPO and post-IPO. If there was a share structure change right before IPO, it's generally advised that that share structure change is also disclosed in the prospectus. And that can include things like a stock split or a share split. It can also include any recent allotments, any buybacks, any exercise of an option, anything like that which would have changed in the share structure is where we advise that it be disclosed. Another thing is that you need to indicate details relating to the offer. This includes simple things like the opening date, the closing date, publication date, the date by which the base of allotments will be issued, the date by which refunds and allocations will start to be communicated, when you expect, of course, to be listed, which is out of the control of the company, but an idea, as well as the amount of shares being offered. With the amount of shares being offered, you'll also have to detail if you intend to have reserved share pools. If you have several categories, you need to detail what each category is, meaning who would fall in the category, the amount of shares of the overall offer being offered to that share pool, and the price being given to the reserved share pool applicants. The reserve share pool categories, I would call it undergoing a slight change, where historically would have seen reserve share pools getting discounted prices or lower prices than the general public. In the past, I want to say at least a year to two, that might have shifted a bit, where I'm seeing more of the prices for the reserve share pool matching that of the general public. And that again is due to ongoing consultation and guidelines being issued by the Financial Services Commission, which will just continue to watch and advise companies as they come to markets. Additionally, the third schedule requires things like the bank loans, overdraft, trade investments, goodwill to be disclosed in the prospectus. This part I call the financial statement part of the prospectus, that you have to highlight and point out to prospective investors how the financials of the company looks. You don't necessarily have to try and extract what the financial says and put a spin on it in the prospectus, but you must be able to point an investor to the document that will indicate where these figures can be found. The third schedule expressly requires companies to disclose if commissions are being paid, and generally this will capture any agreement entered into between the company and the broker-dealer. That is, they're being paid for their services to assist with the subscription or the offer of the shares. You are also required as a company to disclose their preliminary expenses. And these expenses would mean the expenses associated with the offer, which you'll see people refer to as the listing expenses. This includes the broker fee, marketing fee, JSSD registrar fees, the attorney's fees, any other associated expenses with the offer would be put in a big estimate and disclosed to the public, so they are aware that out of the sums raised, this is the amount that will be taken out to repay the expenses incurred. Other things included and required by the Companies Act are disclosure of material contracts, disclosure of directors' interest, meaning that if a director is both a director and a shareholder, that needs to be disclosed. Whether or not that director holds via their personal capacity or a corporate vehicle, that disclosure has to be made, as well as, of course, the auditors and accountants reports for the company. So again, a lot of these things you'll see in the prospectus. The Companies Act is the basis for the reason why those things are included. Next, so once you've ticked compliance with the Companies Act, the next thing you have to now consider is the Securities Act. The Securities Act applies to public companies. So when you're just a private company, the Securities Act generally does not apply to you. And I say general because that's a whole different presentation. But once you become a public company and once you're going to decide to take the steps to make the list, you have to now look at the Securities Act and ensure you're in compliance with the Act in preparing the prospectus. Section 26 of the Securities Act requires you as an issuer to submit a registration statement with the Financial Services Commission. And issuer here means you're the company issuing the shares to the public. That statement is submitted along with the draft prospectus that you send to the FSC for their review. And basically, that registration statement requires you to state things like the company name, of course, the registered address, the principal business office, and things like the name and address of your director, the name and address of your underwriters, if you intend to have your offer underwritten, the name and address of shareholders holding more than 10%, the statement of capitalization of the company, the securities being offered, again, whether it is ordinary shares or preference shares, the estimated net proceeds to be raised. This would be basically the amount of shares you're offering times the price that you're putting into the shares, and taking out the expenses that you expect to incur in the offer. You are also required to name your attorney and auditor, which is important. Why the first slide I went through was engaging these professionals, so that when you get to the stage of submitting the FSC, you have your team on board. In addition to submitting the registration statement, a prospectus checklist is submitted to the FSC. That prospectus checklist is generally signed by your broker. So again, importance of having a licensed securities dealer on board. They would go through the checklist and ensure that the draft prospectus prepared by your legal advisor has met all the requirements on the checklist. Again, I have a list here of 4. This is not exhaustive. The checklist has a longer list, but these are the main ones that I think I just want to touch on. You have to state the risk factors associated with the offer. The FSC's mandate is to protect investors. So, of course, you want to, in preparing the prospectus and writing about the company and trying to sell the company and invite people on board indicate at the same time the risk associated with participating in the offer and coming on board as a shareholder. Another crucial part of the prospectus is the management discussion and analysis. It basically gives a read to the investor of how the company has been doing over the past 3 to 5 years and where the company is going in the future. Capital structure, which we have discussed earlier, is also important because it gives the potential investor an idea of what the company looks like, if there's room for growth, and how the company may go about that. Financial statements, again, very important because the investor is basically looking at the company, the prospectus and the financials, using that to decide whether or not they're going to onboard this company on their books as an investment. There are other things, of course, that you deal with in the prospectus checklist, dealing with things like the projections. You talk about the director's interest. It basically repeats a lot of the things that were in the third schedule of the Companies Act. So again, for you to ensure that you are able to tick all the boxes, you have to ensure that your legal advisor does a thorough due diligence of the company to ensure that everything that needs to be disclosed is written in the prospectus and sent for review to the FSC. So we've dealt with the Companies Act and we've dealt with the Securities Act, and now we have to look at the stock exchange rules. The stock exchange rules, although not legislation, it's still binding more or less on the company if they want to be a member of the stock exchange as a listed company. And we'll deal with all of that when I start talking about the application process to the JSE. But once we reach the JSE rules, the question you have to now ask yourself is, when you're making the list and you're going to the public, are you trying to be a main market company or a junior market company? More or less, the category you fall in depends on the amount of capital you are trying to raise. So for a junior market listing, if you are raising anywhere between 50 million Jamaican dollars to 500 million Jamaican dollars, then you would fall in the category of a junior market listing. Anything in excess of 500 million is now a main market listing. What's important to note here is that the amount being raised or the stated capital that you're trying to achieve has to take into consideration the existing capital of the company. So if the existing capital of the company is $1 million Jamaican dollars and you are trying to remain as a junior market company, the amount of capital that you can now raise is only $499 million. You can't go out and try to raise 500 million because that means your stated capital will be 501 million, which would take you out of the bracket for a junior market company. So again, it's very important to discuss all of this with your broker to have them, to have both you and them understand what you're trying to achieve. You're trying to be a junior market company or a main market company. I'll just insert here that for a junior market company, if you're listed, you get a tax relief from income tax. So that is the benefit of being on a junior market company, and that is very helpful for MSMEs. So once you've identified if you're a main market or a junior market listing, the rules more or less have the same ethos to it, but different requirements for certain things. So for a main market company, if you are making an offer to the public, you have to ensure that post the offer, no less than 20% of the share capital of the company is held by at least 100 shareholders. Whereas on a junior market company, it is the same requirement. However, the 100 shareholders needs to be 100 new shareholders. Again, in the market that we're in, it's not really hard to onboard 100 shareholders. We have a lot of these listings where companies are onboarding 3,000, 4,000 shareholders post-IPO. But it is again important in the event you get to that point that before you submit your listing application after closing the IPO, that you ensure you have at least 100 shareholders for main markets or at least 100 new shareholders for junior markets, holding no less than 20%. The next thing is for a main market company, they do require the company to have an audit committee. This being a committee of the board of directors, and that audit committee must have at least 3 members who are non-executive and a majority independent. So when you're, again, creating your board, which we will get to in another slide, you have to take these, the provisions of the JSE rules into consideration in making the board. For the junior market company, they require both an audit and remuneration committee. And for those committees, you must have a majority independent, non-executive director. Junior market companies require a mentor, and the mentor has a role under the rules, basically saying they need to be there to help the company through corporate governance, ensure they're in compliance with the rules, to provide advice to the company in situations where, I guess, the directors on the company's board would not necessarily have the expertise. There's a list of mentors provided for the JSE, and the junior market company would have to select an individual from that list. In some instances, if requested by the company, the JSE will waive the requirement for having a mentor. However, in submitting that document to the JSE, you would have to justify or show the JSE why they should waive the mentor requirement, and that will be considered when you submit your application. Even if the JSE waives the mentor requirement, the JSE will still ask which director or directors will carry out the role and responsibility of the mentor. So even though you're not appointing a mentor, you still need to have someone to fulfill the roles of a mentor. So you'd have to keep that in mind when you're creating your board, whether you have people who can carry out the mentor responsibilities, or if you need to create your board and also appoint a mentor. For a junior market company, the board of directors should have at least 2 independent non-executive directors. So again, in creating the board, very crucial to keep this in the back of your mind. So I'm going to take a step back now from all the regulatory aspects and the checklist and the steps to go and look at the business operations of the company. So the business operations of the company need to ensure that they're ready, not only to just continue operating as a company, but ready to operate as a public listed company. Being a public listed company puts the company at a higher standard, in my opinion, in not just operating to ensure they make money, but operating to ensure that they're accountable to their shareholders and stakeholders. So the first thing on my list here is the corporate structure. So before you take steps to make the list, or while you're taking steps to make the list, you need to look at where your corporate structure of the company is now and decide whether that corporate structure is a structure you want to keep for a listed company. And this may include things as to, like, if you have a subsidiary or a affiliate that is in the group that you don't necessarily want to form part of the listed company, whether you want to keep it or put it out to just be a related entity, or if you want to complete an acquisition before you become a listed company so that your corporate structure is bolstered. Those are things that you do want to consider while you're taking steps to make the list. The next thing to take into consideration is your executive and senior management team. It's important to understand that the people you have fulfilling these roles will now have to understand the added load of becoming a public listed company, as they're no longer just operating to report to the 5 or 4 shareholders and the board, but they're now operating to be able to report to 3,000, 4,000, probably 8,000 shareholders. It will require them to lead and report in a certain way that might be a little bit more stringent than how they operated before. So while you shouldn't be having discussions generally with everybody about you're going to market, because you're trying not to condition the market, you have to ensure the staff complement that you have is ready and able to support the public listed company lifestyle. Another important part is your service contracts. And service contracts here I'm using in the broadest sense to apply to whatever sector of the industry you are in, or whatever contracts you use for your business. You need to ensure, I highly suggest that your contracts are as tight as possible. They're in writing, because another important thing to realize is that when you become a public listed company, you are now more on the radar to be in the public domain for missteps. And you want to avoid a misstep, or you want to ensure that if there is a misstep by either party, you have provisions in a contract to protect yourself. You also now need to ensure you keep paper trail and everything ready for your auditors when it comes, because having audited financials every year now is no longer, I'll do it when I need to or get it in time for my AGM, but I now have requirements under the JSE rules to meet a particular deadline. Another important part is the employment contracts as well. You have to now ensure that your employers understand their roles and responsibilities similar to their service contracts, same line of thinking. The service contracts and employment contracts are generally reviewed in a due diligence exercise to see if there's anything in those contracts that needs to be disclosed in the prospectus. So, for example, if you have an employment contract with your CEO where you have a share option given to him for a particular period of time, that is something that would need to be disclosed in the prospectus. Land-related agreements, for example, leases, would also need to be disclosed in the prospectus, especially if the land to which the lease is subject to is a material part of the business. You need to ensure that prospective investors are aware of any risk associated with where the company operates, or on the plus side, it could be that they are aware that the company owns this property and is leasing it to somebody else. So that's another source of revenue. Those are documents that, again, we review in our due diligence to see or decide how it is disclosed in the prospectus. Other important things are insurance policies and intellectual property. Intellectual property is very important. You want to ensure that anything you use, whether it's a trademark or a domain name, is registered, so you can, in the event something happens, you can bring action against someone for using it without your consent. Again, when you become a listed company, you are now more on the public's radar, and people will want to use and misuse your intellectual property probably more. Policies and procedures are important parts of business operations, and this goes through the entire skeleton of the company, from the employees to the executive and senior management right up to the board. Policies and procedures need to be in place so everyone understands all the things that need to be complied with, separate and apart from the prospectus. But going forward, you're now a company that will have to comply, or let me not say you are now a company, because as a company, you should have policies and procedures in place that you want to comply with that deal with employment, anything HR related, data protection if that applies to your company because you collect personal information on individuals, KYC information depending on the type of company that you have, or if you fall within the entities regulated by the Proceeds of Crime Act. And you also want to think of things of, if you're in a particular industry that has a certain standard, like in the health sector, you have to ensure that you have policies and procedures in writing and what communicates to the employees to ensure that you're operating. Again, it's important, not because you're becoming a listed company. Yes, it's great you're becoming a listed company, so you want to dot all the I's and cross the T's, but as a company, from a corporate governance perspective, and an operations perspective, to ensure you operate as efficiently as possible. Lastly, risk management framework. And interestingly enough, this doesn't generally come up with a lot of smaller companies. When you hear risk management framework, it's generally like a big group of companies that's, on a larger scale. But I highly recommend that no matter what type of company you are, once you're operating, that you have some risk management framework in place to deal with the different risks which arise in operating your business. As a company trying to make the list, having a risk management framework will definitely help to respond to any crisis that may arise and to make the necessary disclosures as required with the JSE rules as soon as possible. So again, in making the list, it's not just let me look at my prospectus, figure out how much money I want to raise, complete the prospectus kind of approach. It should be like, let me think of long-term how I'm able to operate as a public listed company, dealing with all my new regulatory requirements and still ensuring my business can operate as efficiently as possible. Board dynamic. This one is very crucial to a public listed company, because in the past, where it would be a private company and maybe the shareholders and the directors are the same, right now you're going to have a board where you will have 5 or 6 directors with thousands of shareholders. The board needs to be operating at full speed. They need to be working together as a team to be able to ensure the shareholders have faith in how they can run their company and their investment. So again, I've listed a few things here that would affect board dynamic, but again, not exhaustive. And board directors can be trained as to how to ensure that board dynamic evolves as the company grows. So the first thing to consider is your board committees. You want to ensure that you have the minimum board committees required under the JSE rules, but that doesn't mean you have to stop there. you can add other committees like your corporate governance committee, as well as your remuneration committee. You could even have a separate risk committee from audits, something for the board to discuss. Once those committees are created, you also want to consider the charters and terms of reference. Those generally discuss how the committee meetings are to be held, how notices are to be sent out, what are the responsibilities of the board committee, how they report to the board, and timelines. The next thing to look at when you're creating your board is your board expertise. You want to look at your company and your business and decide, based on my company, what type of board expertise do I need? Meaning, in what ratio? Because I do believe that you need a wide expertise on your board to cover the different areas. So you could be in the manufacturing sector, but that doesn't mean that all your board members need to be people who are businessmen in manufacturing. You want to have a balance of risk management, legal, finance, business, manufacturing experts, maybe somebody who deals with marketing, sales. You want to ensure that your board can operate in a way where no one area of the company feels weaker than the other. Again, the ratio would differ depending on the type of company. If your company is in the financial sector, you might have more board members who are finance-based than if you're in the marketing sector, where you might have more board members who are sales. Another thing to consider for a board dynamic is the remuneration that you will give to your board members. So what are you going to get? What are you going to pay them? Generally, the provision stated in the articles of most companies is that the directors who get paid are the directors who are non-executives, meaning they don't work with the company on a day-to-day. They're not hired as a CEO or a CEO or anything like that. Again, that is up to the shareholders and it's generally stated in the articles. You can have a variation of what that remuneration would be. Strategy and accountability is something very important to the board dynamic. And while we don't generally advise companies, of course, as to what they should be, it is something that we point out to companies that they should instill in how their board operates. The board has to know that going forward, they're not just, again, operating for a family business or a small mom and pop kind of thing, but they're, again, reporting to thousands of shareholders who are waiting for an investment, a return on their investment. The board needs to be ready to identify opportunities, establish objectives, assess the risk, and ultimately be accountable to shareholders. With all this in mind, the board also has to keep in the back of their mind how they reply or respond to the obligations under the rules. So it's great to identify all these opportunities. It's great to identify a company to acquire. It's great to want to buy assets of another company to bolster your business. But under the rules, there are certain requirements like making timely disclosures. When certain things are happening with the company, the rules require the board to disclose what is happening so the shareholders can be kept abreast of what is going on. So in just trying to operate the company and give directions to the executive team, the board needs to also keep in the back of their mind what they need to do to comply with the rules on an ongoing basis. Again, what's very important is at the beginning to engage a legal advisor and a securities dealer to assist with these obligations. Another important part of board dynamic is ongoing governance, and you'll hear me stress it right throughout, is once you become a public listed company, there's a threshold that you've thrust the company in that you just can't go below, or you should not be going below. You should ensure that you have things in such a way that is very easy for the company to deal with issues and concerns and matters of the shareholders in a efficient manner. So while I've stated under governance things like how and when meetings are held and board papers, it goes beyond just the board operations. It goes beyond stakeholder engagement and shareholders ensuring that shareholders feeling that their rights aren't being infringed and aren't actually being infringed. So this again is a whole other presentation. This could be a whole presentation on the corporate governance code and the requirements under the rules on corporate governance. But this is something that public companies definitely need to keep the forefront of their mind. So we've discussed all those great things about what you need to look at, what needs to be discovered by your legal advisor and the securities dealer, what you need to disclose, documents that go to the various different regulators, but a timeline. You have to, again, look at the timeline and what needs to be considered in the timeline. So I've set out here a few things in no particular order. Again, it depends on the transaction structure and things that are uncovered during due diligence. But in your timeline, you should be stating things to deal with a timeline to conduct both legal and financial due diligence. You need to ensure that the company is in good standing, both at the Companies Office of Jamaica and the Tax Administration of Jamaica, because the certificate of good standing and the tax compliance certificate are general documents made available for inspection. You want to put in the timeline for drafting the prospectus, having multiple versions of the prospectus being turned up between the team, legal drafting, sending to the company to review, brokers' inputs, and just having discussions until you get to a point where you say this prospectus is now final. We can submit the draft to the FSC and the JSC. You also want to look at holding your directors and shareholders meetings to pass the necessary, what I call IPO resolutions. You'd have to look at your articles to get an idea as to, one, whether you can pass round robin resolutions or if you actually have to convene meetings. Convening meetings would require you to do things like giving adequate notice, convening the meeting, ensuring you have the proper quorum, placing the resolution before the shareholders and having them passed. Those resolutions will form the basis of your application to the JSE to become a listed company. You also want to put in regulatory engagement. What I mean by regulatory engagement is the discussions with the Companies Office, the Financial Services Commission, and the Jamaica Stock Exchange, and dealing with different versions of the prospectus and the feedback from all three regulators on the different versions of the prospectus until you get to a point where you have approval from all three regulators to go ahead and publish the prospectus. You're also going to need to include financials. So again, you have to look at your bigger picture and decide what quarter or period in the year you're planning to list, and then account for what financials will need to be included in a prospectus. So for example, if you intend to list in, let's just say Q2 of a particular year, you would need to include the audited financials for the previous year end. And this is on the premise that your financial year is from January to December. So you'll be including your audited financials for the year in December 31st of whatever year, and then potentially including a compilation report for the period January to March of the following year. Again, the regulators require I call it an updated financial between your audited and listing, because they want to give the best picture to the potential investor. In addition to the financials, you have to look at the documents that you would need to file with the Companies Office. So if you are going to do a subdivision or a stock split, you will need to file documents with the Companies Office to reflect that. If you issued shares right before, you need to ensure that all those documents are filed before you go to market. Corporate governance, again, a big heading. You need to inject that in your timeline, and that will include things like forming your board committees, dealing with creating the codes for the company, anything along that line. You need to put that in your timeline. Of course, your timeline is going to have your IPO open and close dates, and then all of the post-IPO closing things, which include meeting the timeline to issue your basis of allotment, dealing with returns, submitting your application to the JSE for listing. All of those are post-closing, reporting to the FSC. So post-IPO, on the route to list. So you've done your due diligence, you've drafted your prospectus, you have gotten it registered with the FSC and the Companies Office, you posted it on the JSE's website, you had a raise, oversubscribe, and you close. What next? It's not just, we close and the money's in the company's account and we go. No. Post-IPO, you still have certain things to tick off before you even list for the shares to start trading. And again, we deal with the regulators. So from an FSC standpoint, you have to submit what I call an issuer's report. That report is basically telling the FSC a summary of what the IPO of the IPO. So you remind them, of course, that they registered the prospectus, the opening date, the closing date, and you indicate the basis of allocation for the shares based on the applications received. And that is generally provided or prepared by the broker, and the attorney can assist with submitting that to the FSC on behalf of the company. From the JSE standpoint, you would now have to take the necessary steps to actually apply to be listed on the exchange. So yes, the JSE would have reviewed the prospectus and said, okay, they have no problem, but your application cannot go in until the IPO would have closed. So you would have prepared the shelf documents, and these include the admission agreement, the listing agreement, your declaration of admission, things like the directors and shareholders resolution, which we discussed earlier. You would have to also include a list of your shareholders based on the IPO, and in some instances, a letter or legal opinion from your attorney at law. Once those documents are submitted and you pay the relevant listing fees, then the JSE would convene a listing committee meeting to consider your application. And once the application is approved, then a date will be set for the listing ceremony. Once the listing ceremony happens and the company is listed, the shares can begin to trade between the shareholders on the exchange. Other than the JSE and the FSC, there's again another agency to deal with, which is the Companies Office, and you will require to file your return of allotment and the beneficial ownership return form. The return of allotment is basically a document stating who the shareholders of the company are and how many additional shares have been issued. The company will have ongoing obligations with the Companies Office, as a company, of course, going forward. And that would include filing things like annual returns and anything else that changes the structure of the company, and the change of the directors, things like that. So again, post-IPO, there's still things that need to be done to make the list. So you're listed, what no? So many people appreciate the work and time it takes to get listed. And yeah, it was quite a mouthful, so you realize it's a lot. And this is, again, probably only on the surface. Some also still tend to forget that why you did all this hard work to list. Once you list, there's a lot more obligations to come. But again, if you take the steps to put certain things in place from before listing, comply with the obligations post-listing should be easier. You would have continued obligations under the Companies Act. You would now have new obligations under the Securities Act as a public company, and then you will have obligations under the JSE rules. It's important to remember that a listed company who fails to comply with these obligations may be suspended or delisted. And the company could also face a penalty under the Companies Act or the Securities Act, depending on the obligation that it has not been fulfilled. So a company just wants to ensure that in making the list, they're not just preparing to be listed, but they're preparing to remain listed and operate as a listed company going forward. So feel free to contact me if you have any questions at shaniel.maybrown@mfg.com.jm. And I hope this was helpful for anyone out there who's trying to make the list.
Awesome. Thank you so much for such a comprehensive presentation. I'm almost wondering whether or not I should have Learn, Grow, Invest prepare to list, because that feels like such a life-changing journey. Right?
It is. It's fulfilling, I must say. And it's fulfilling for me as the attorney. I can't imagine how it feels for the actual client who completes a listing. So.
All right, so I do have a couple of questions, and I imagine that after watching this, our audience may have a few as well. So for those who are watching this, if you have any questions, just post it in the comments underneath the video, and we'll try to organize a Q&A. So I guess we'll see how the questions are coming in, and then we'll probably schedule a Q&A at a later date. So my first question is, at what point is it right for a company to engage with a law firm? Is it that, let's say Learn, Grow, Invest is the example here. We may want to list, we're planning to list. Is it that I have the thought and I reach out to someone like you at that point, or do I start to get some things together first before we make contact?
I would say once you have the thought, feel free to reach out, because what's crucial, and I'm going to use the example of One Great Theater because that would have been my recent listing, is that you don't have to wait until a year before you plan to list to come to an attorney. You can have the 5-year plan saying, this is what I want to do, without even telling the attorney, but letting them have an idea of you're trying to, grow the company. So the attorney can help you put all your ducks in a row slowly over time. You don't have to say, I want to list, so let me just start dealing with a prospectus 2-3 years out. No, that's not necessary. What is important is to have an attorney, if you don't already have one, on board to ensure from a company and a corporate governance type position, your company is operating in line with the Companies Act. That's always the standing. So when you come to us and say, well, I want to list in a year or two, we're going to say, okay, no problem. Let's start doing a due diligence on the company. Let us see where you are with your company operations so we can identify anything we see as a red flag that you have not been doing so we can let you know to do it. So if you haven't been filing your annual returns on time, those are things we're going to start flagging. If you have intellectual property that you haven't registered, we're going to say, hey, you need to register things like this. If you're entering into certain agreements that we don't think will necessarily be favorable for you in listing, we're going to point out the risk associated with it. So reaching out to your attorney is never, let me wait until I want to all hands on deck kind of thing. No, you can reach out at any time. You can reach out to your attorney before you reach out to your broker. Yeah, that's how I would put it. You have the thought, reach out, bounce it off somebody, and they'll let you know if they think now is a convenient time or a better time is further down. And I'm pretty sure 9 times out of 10, they'll say you've come right on time.
All right, cool. So what is that process of engagement like, right? Because I figure that, let's say that Learn, Grow, Invest engages with you. How often are we meeting? What's that process like? Because I'm figuring that once we start working together, you're likely to retain those clients after listing, right? Because they're going to need
That's the
ongoing
hope.
support.
That's the hope.
Okay. So what's the engagement like and the communication before listing and then post listing?
Okay, so generally when we start the engagement process, we do terms of engagement where it will deal with a particular matter, which may be the listing and associated matters. And we would discuss at that point a fee structure, what's acceptable to both the attorney and the company, because we're all about relationships and we're trying to make it work for everyone. So we have an open conversation about that, as well as timeline. The reason timeline is important is timeline will affect how often we meet. So if you want to list in 3 years, it's not going to be a situation where we're meeting 3-4 times every month. But if you're trying to list in a year, we may very well be having a weekly catch-up meeting to ensure that all our deliverables are on track to meet that year. So again, it just depends on the particular company, the timeline, and where they are with engaging other professionals, if at all.
Okay. So it means then that the process of listing would be considered a separate engagement from what would be required post, right? So meaning, because when you said you hope that the client remains with you, it would be, I guess, treated as a separate engagement in a sense.
In a sense, we can have an engagement where it's ongoing to provide ongoing advice in certain situations. So that can happen. And the reason I said I hope is because, again, and you see me stress, people are driving to make the list and they get listed and you're like, okay, finish now. We don't need any more attorneys. I can manage this on my own. Peace out. Until, again, something happens or, knock on wood, RMOD writes them about something. So we try post listing to keep in contact with the companies and remind them of certain things, and to just ensure that they're meeting all their obligations. And in time, most companies realize that it's important to just still have your attorney there to assist you with things, especially as you become a listed company. Because as I say, when you're a small company, things happen and people just look at you and shrug their shoulder. But when you're a listed company, something goes wrong. Can you believe this listed company is operating this way? So, yeah.
I do have a question as it relates to, so we've seen recently that a company was actually the trading of their shares was paused on the JSE because of a governance issue, right? How does a company get to that point, right? And I mean, no, I know the scenarios can vary, but that was a cause for concern for a lot of investors, right? Because they're wondering how it got to that point. And I know we had a company in the past that was actually delisted, right? Can a company be redeemed after they've been delisted, or is it like if you're off, you're off?
So you can be redeemed after you're delisted. You can relist. So, and I said redeemed because yes, you get relisted, but are you really redeemed in the eyes of the public? That's a whole different conversation, and that would have to be like a market kind of read. So you can be redeemed. If you get delisted, you can reapply to be listed, and the listing committee will again consider you for relisting. In that sense, you would be your application to relist would be done by way of introduction. It wouldn't be done by an IPO because you'd have already done an IPO. You can only ever have one IPO. So that is possible for you to be relisted. In the sense as to how you get to a point where you are in breach of an obligation to be suspended, I wish I had the answer for you, Jameen, because again, if you ensure that you have the policies and procedures in place and you have different checks and balances, you should be able to meet all the obligations. There may be situations that are out of your control that you generally just can't have the documents ready because of a third party. But again, the rules indicate how you deal with things like that. You have timely disclosures explaining why something is not being met or and the reason behind it. And again, the company will just have to be as transparent as they can be about it. Because ultimately, you just have to remain accountable to your shareholders. That's who you're reporting to. It's not about the board, or yes, you report to the JSC, but it's not about the JSC. The JSC and the FSC are focused on the shareholders. They want you to do these things because the shareholders need to know what's happening. So I want to say it's more of a culture that you have to create in your board and your company, so everyone knows the importance of meeting these obligations. But I will admit that there are some aspects that will be out of your control no matter how hard you try. But that should be the exception and not the norm at all.
All right, there's so many more things I want to ask you about that topic, but that's for another video. So I would the next question. So you mentioned companies may seek to have their offer underwritten by the broker. What is that process of underwriting? What does it mean? And what are some of the, I guess, the ways in which that might be used for companies seeking to list?
So the underwriting agreement is generally dealt with at the same time the broker is being engaged. At least that's what I've experienced in the transaction that I've been a part of. The same time the broker is being engaged to be the broker and arranger, some agreements may outright say that we will underwrite, or some agreements will say that the company has the right to request that the IPO be underwritten and the broker will consider it. How the process for whether that is approved or not is done, I think a securities deal will be better suited to give you that response. But basically, if it is that a company uses an underwriter, what will happen is that if the IPO is not, I don't want to say not successful, because that's just, too negative. But if the IPO is not being onboarded by investors in the way the company expects, the underwriter, which in most instances is the broker, will guarantee the amount that is not fulfilled by the public. So if you're doing a $500 million raise and the public is only applying, or the applications that have come in only amount to 350, then the underwriter would underwrite the difference. There may be different terms and provisions for other agreements, but those are the ones that I have seen in practice.
Okay, so it's almost like some form of protection or assurance from the broker that, okay, just in case, we don't see full take up, we'll cover that gap for you, essentially.
Right.
Okay, cool. Are there, well, you mentioned just two final questions, really. You mentioned companies sometimes seeking to maybe get a waiver for having a mentor. This is the junior market companies. Have you seen where companies that opt not to have a mentor, that it has a negative impact?
So I only know of 2 companies right now that have requested a waiver of a mentor. One was stationery and office supplies. When they were listing, they requested a waiver of their mentor. They seem to be operating just fine. I do think when I looked at their board at the time, they did have expertise to manage. I think when they listed, they had a mentor who was appointed, and then when the mentor ended the agreement, they decided to waive the requirements. So maybe the board felt after having the mentor for a period, they were now good to go to manage. They've seemed to be doing well. The other company I'm aware of would be One Great Studio. They did request a waiver of the mentor requirement, and they did get that. But interestingly enough, they have on their board Jacqueline Sharp, who is a approved mentor. So even though they don't actually have a mentor, they have a director who could have been a mentor, as well as other directors on the board to deal with the different areas that a mentor would deal with. And I have no doubt that 1GS will also operate like SAOS, where they can manage without having an appointed mentor. I think, and this is just me saying it without actually having really a history of the rules when it was being created, but I think the idea of having a mentor in place for junior market companies at the time was on the premise that the junior market would have been for very small MSMEs, mom and pop kind of setup that maybe wouldn't have people who were, ready to deal with corporate governance and compliance and things like that. But I think where we are now, it's very evident that that has changed. Junior market companies are coming to the market with boards that are, definitely have a great CV behind all the directors. So maybe we'll see more waivers being requested in the future. Who knows?
Yeah, so I wanted to actually go into that point a little bit that you mentioned, because JC has spoken about opportunities for even smaller companies, right? Because we have seen sort of almost like the quality of companies coming out be at a certain standard, actually, well established boards, companies doing, hundreds of millions or close to $1 billion revenue, etc. So they're not really considered small companies in a sense, right? How do you think the process of listing maybe too cumbersome for a company seeking to raise 50 million, 100 million, that kind of thing?
I think yes. And the reason I say yes is maybe the initial process of listing won't be cumbersome for all, but I think post-listing that may become burdensome on a company who that's very small. And the reason behind that is if you look at the different things I discussed and the obligations that will exist post-listing or just touched on, you'll realize that if you had a 5-man kind of company dealing with running the operations of the business, with these onboarding obligations, you're going to need somebody else. It's going to be hard for you to try and be CEO, data protection officer, human resource officer, and compliance officer. You might slip up. And that may become difficult for you to incur the cost to have a third party assist you. May not be possible, but it may be an obstacle for some smaller companies. Again, maybe that will change. It also depends on the state of the company. Because in my opinion, at least from my practice, the older the company is before going to market, I do think it's a little harder to get them ready for listing because the due diligence now is a much deeper dive than a company that's around for 5, 10, 12 years. And I know I said older, so you might think that 10 years is old, but no, 10 years is not bad. 5 years is not bad. But when you start looking at the company that's been around for 20, 25 years, and you're trying to ensure that, everything is great to go to market, it gets a little harder. It's also a little harder to break the culture of a company that's been around for that long, for them to now become a regulated entity. Yeah.
Interesting. Again, so many questions that I want to ask, but we're keeping this within an hour, I promise. So final question is relating to the board. At what point do you think it's important for a company to have its board in place?
Once you incorporate that company and you're operating, I don't think you need to wait on listing to try and make your board corporate governance ready. You should have a board that's always corporate governance ready once you've incorporated a company. And I'm not saying it needs to be a board of 7 people with 7 experts. It could be as simple as having 3, 4 board members where you have people to cover all the different areas. You need to start practicing having that board meeting, practice having the board papers. Separate and apart from listing, those are crucial steps to take as a company, because the Companies Act has a lot of requirements that companies aren't even aware of until they are ready to list and we're pointing it out to them. So, yeah.
All right, great. Thank you so much. This was a great overview. As looking at your presentation, I'm like, I really have to consider listing very carefully because I know you gave us like the condensed version. I'm imagining this process taking place over months, maybe
Yes.
years for some companies, but I think it will help our audience understand and maybe appreciate the work that companies have to do to prepare to list, right? It's something that kind of adds, some overhead, right? So companies have to be ready for that. And there's a lot that goes into them preparing to report to shareholders to keep them informed. And it's something that maybe investors don't really appreciate as much, I think. So,
And I don't want my presentation to come off as a hindrance for people to be like, well, this is way too much work, let me not list. I just strongly believe that once you're aware of everything that you need to get done and you're ready to put your foot on the pedal and you get your team in place, so that's your broker and your attorney, it will happen. It will work.
yeah.
So don't let it stress you out too much. That's why you pay the advisors.
Yes, exactly. All right. So I know you mentioned it at the start, but mention it again briefly how persons can reach out to you and maybe what areas of expertise you have so that persons can, know when it might be best to engage with you.
Okay, no problem. So I can be contacted by email at Shaniel, so that's SHANIEL .may, MAY, Brown, BROWN, at mfg.com.jm. You can also contact me by calling 922-5860. So you can reach out and contact me there. My areas, so I'm in the commercial department, which means I deal with anything commercial related, anything company related. But my areas of expertise at the moment are anything securities, financial regulatory advice, compliance, mergers and acquisitions, tax, data protection, and cybersecurity. That also includes things like shareholders agreements, subscription agreements, share purchase agreements, and joint venture agreements. Other than that, though, Master Gordon is a full-service law firm. We have a property department as well as a litigation department. So if I personally can't assist, I definitely can find someone to help.
All right, great. Thank you so much, Shaniel. Just awesome presentation. And I know we'll get a few questions and we'll prepare for that Q&A when the time
No
comes.
problem. Thanks for having me.
Great.